wanted to talk to everybody about a lot of conversations we've been having around estate planning. Hey, Guadalupe, around estate planning and tax planning, et cetera. We are not CPAs, we're not estate planning attorneys, but to have these conversations at a high level with clients because what we do is not money management alone. I think there's a distinction that needs to be made between money management and wealth management. Money management is just, hey, what do I invest in? Wealth management is, hey, like, how do I consider taxation in my investments? How do I consider estate planning in my investments, et cetera, et cetera. So the whole balance sheet, holistic balance sheet perspective. And one of the things that we've been talking a lot about to clients is what if we look through the lens of your buckets, your tax buckets. So if we say, okay, you have all of your capital and it's either in a taxable bucket, a tax deferred bucket, or a tax free bucket. Now, tax deferred being 401k, IRA, et cetera. Now, you probably already know that the government will force you through what are called required minimum distributions, RMDs, to take out that money at certain ages, right? And it is percentage based. And then also you will pay taxes on that money. And then here's the kicker, that when that happens, the only option essentially that you have is to then put that money back into some sort of taxable account. And Colin, you keep me honest on this, make sure I don't miss anything. So, and now that could be a taxable investment account, it could be a checking or savings account, et cetera. And what we're talking to clients about is saying, hey, there is another method called a Roth conversion, right? Where you actually convert the money, right? Now you still pay taxes on that money. It's the same tax you otherwise would have paid through an RMD. But the cool thing about it is then that money gets taken and it's dumped into the tax-free bucket called a Roth account. So the cool thing about that is when the money lands there, you no longer have RMDs, right? And yes, you still have to pay the tax, but the money will then grow tax-free. And under the current legislation can be then passed to your children, your beneficiaries, and then they get those same benefits for up to a decade, tax-free distributions, tax-free growth, tax-free dividend reinvestment as well. We're talking about, hey, if we look through the lens of our clients and our investments, and you look through the lens of all of your money and say, okay, does it land in the taxable bucket, the tax deferred bucket, or the tax-free bucket? Now, the more money we have stocked away in the tax deferred bucket means at some point the government is going to force us to take out that money because they've said, hey, you put more money in your 401k, your IRA, et cetera. We've never gotten our taxes from it. So we're going to force you through a process called required minimum distributions. And they're going to give you a percentage that is non-negotiable. All right, you got to take that money out. And then the kicker is that money can only be funneled back into a taxable bucket. And you're not going to be able to put it back into the tax deferred unless you have earned income, et cetera, et cetera. Versus if we consider a strategy of a conversion. So instead, we voluntarily take the money out and we convert it, right? Number one, yes, we still pay the taxes, but you would have paid the taxes anyway. And then number two, it allows us to then funnel more money into the tax-free bucket, the Roth bucket, right? So that way, once we pay the taxes, now we get tax-free growth, we get tax-free dividends, and we get tax-free withdrawals. And then, God forbid something happens to us, we then send that on to our beneficiaries, and they get the same benefits for up to 10 years. So it might not be applicable for every family, but for a lot of our clients, we're having this discussion at great length and saying, hey, this might be one of the things that we want to consider doing as long as you're willing to do it. Now, there's some stipulations, right? Like the government says they don't want you spending that money within 5 years. And that can kind of spook some people because then they penalize the profits, et cetera. But the reality is for our clients, 99% of them, if not the majority of them, do not want to spend any of that money. That's the last bucket of money that they want to touch because they want to make sure they harvest that benefit for as long as possible for not only themselves, but for their beneficiaries. Colin, let me throw you the mic, buddy. What are your thoughts?
Yeah, I think two things that I would reiterate from what both of you had said, right? So You hinted at it, but I would like to just elaborate quickly on how punishing it is to leave a surviving spouse a bunch of tax deferred money, right? When it's typically the males, just by numerically speaking, right? But when the first of the spouse dies, the surviving spouse just lost half of their deductions and half of their tax bracket, right? Therefore, making any dollars that are in that middle tax deferred bucket more punishing to the surviving spouse, right? And a few people on this call have probably heard this story, but this just happened to my grandmother. She unexpectedly lost her husband, right? She's 81, he's 79. Her both of her parents lived into their mid 80s. I'm sorry, mid 90s, right? So if she just lives the same life that her mother and father lived, she's going to live another 14 years, and she's going to do so with a bunch of money in tax deferred assets that she's now paying single filer rates with half of the deductions that she formerly had as a married couple filing joint on the tax return, right? So this tax planning could be beneficial for both spouses, but it's certainly beneficial for the surviving spouse. And that widow tax typically creeps up on people. It's not all that fun to talk about your spouse dying, right? But in my instance, in my grandmother's instance, she's likely to be a single filer for a decade plus, and now those dollars, when they're at their all time highs, and the required minimum distribution percentage is pretty stinking high, right? It's like upwards of 8% at this point. She is being forced to pay dollars in a more punishing manner simply because of the tax code, right? I want to parlay that into my second point, right? The reason that we separate your assets into these three buckets, or these three cohorts, so to speak: taxable investments, tax deferred investments, and tax free investments. We want to look at it through the lens of the IRS, right? So we want to see, how do they view the way that you're holding your money. We don't want to break any laws or do anything unethical, of course, right? But we want to understand what the system is that's set up for us, and how do we use it to our advantage, right? If we understand that, we can look out, right? The next year, the next 2 years, the next 5 years, the next 10 years, etc. And we can start to do tax planning that puts us in a materially better place. Again, based on the way the system is set up and designed, right? So this is common at every level of wealth, and we just want to take advantage of, hey, what's specifically or uniquely advantageous to you. Our clients all look a lot alike, right? They have a lot of money in tax deferred accounts, so we can use these strategies with most of you, many of you, and put you and your family in a better position, by being forward thinking about tax planning, which is typically basically the opposite of typically how we view taxes. We're typically showing up to April 15th, looking back the last 12 months, the last 18 months, right? Saying, how can we reduce our tax bill retroactively, right? I think we want to flip that on its ear a bit and say, hey, looking out the next year, the next 2 years, the next 10 years, how can we lower our cumulative tax bill so that we don't have this looming tax rate risk, especially if we're going to find ourselves as a country in a rising tax rate environment.
Yeah, let me ask you this, because let's break this down logically. Um, the way that you might want to think about it is, okay, do I think my tax rates will increase or stay the same or decrease in the future? So now, while none of us know the real answer to that because it's in the future, let's break it down rationally. Colin, what is your best guess at the current level of debt America has?
Yeah, we're sitting right about 35 trillion in national debt, a little over.
Right. So we have historically high debt, and the interest on that debt within the last year and a half has it just increased dramatically relative to the prior decade. So now, if we look at government spending, it's my understanding that, okay, we can only solve this problem, America's, let's say, debt issue, on two sides of the ledger. We either reduce expenditures or we increase revenues. So let's explore the idea of the federal government reducing its expenditures. From my understanding, 96% of federal dollars spent are spent on about 4 programs. If we look, the majority of those are to the benefit of an aging demographic. So the probability, and then defense. So and interest. The probability, at least in my opinion, that we make any meaningful dent in reducing the expenditures when we look at what those programs are actually funding, I don't know, call me crazy, but it seems highly unlikely. So then we know if we're gonna reduce expenditures at all, it's gonna sit within the smallest slice of the pie, which is roughly 4% of what's left over. So these are all things that you and your family have to consider, though. Now, so then we have on the other side, well, if in my view, the probability of reducing our expenditures is slim to none, well, then we can only talk about the other side of the ledger, which is increasing government's revenues, and the government makes revenue by increasing taxation. So that's one of the pieces of connective tissue that you might want to think about on, okay, should I look through the lens of my tax buckets, and should I be considering conversions to stockpile some money into more tax advantageous buckets for the long term? Colin, any final words on this topic, buddy?
Yeah, I mean, it's a relative issue, right? And it definitely needs to be a personal calculation, right? So we need to look at it on the individual level, and that's where I think the industry as a whole, the financial planning industry as a whole, this is starting to become a more popular topic, but they're doing what they're really good at, and once again, just giving these really generic like rules of thumb or widespread advice, more than likely because they don't wanna take the individual liability on it, right? And that is that's probably not going to be enough for your situation. So this is, again, a personal calculation. We have to run the numbers on you and your family, and that's it alone. But that's ultimately the best news of it all, right? Because the government and the IRS and all the problems that they have will not affect you personally if you can take some control of this and implement something that benefits your family in a material way moving forward.
Well, and here's the other thing for people who are saying, "Hey, I have some money in Roth and I have some money in an IRA, et cetera." Um, we want to transition now to thinking about estate planning. How do you hand your assets over to the beneficiaries? So let's just explore a concept. If you have $1 million in an IRA and $1 million in a Roth IRA, and then you just say, "Hey, kids, just split these accounts, and then whatever you want to do with it." Well, let's just say if one of the beneficiaries is in the top tax bracket, right? And you hand him an IRA. Well, you probably just created a disproportional problem if you have another beneficiary who's in the lowest tax bracket, to make it an extreme example, right? You just put undue pressure on the higher income earner when you didn't have to, right? So thinking through the lens of taxation can be really important to a family, and I would say could make an exponential difference to the whole family legacy and their financial plan.
So the question posed here is, are there any implications or impact of when within a year a conversion occurs? So basically, should we do it at a certain time during the calendar year to be more beneficial in terms of a Roth conversion? Well, the first thing that I'd point out there is this is different from a contribution. And a lot of times people get those two things mixed up. A Roth conversion and a Roth contribution are two entirely separate things, right? So, as many of you know, you can make an IRA contribution for, let's call it 2024, all the way up until tax filing time. So, April of 2025, all the way up until April of 25, you have the ability to contribute for the calendar year of 2024. A Roth conversion, however, has a 12/31 deadline, right? So the first thing that I would talk about when we were talking about the timing of a Roth conversion is just to make sure that if you are going to pull the trigger on one, just understand that there is a deadline, and it's a calendar year deadline, not a tax filing deadline, right? So that'd be the first big point that I'd bring up. From there, this is a horrible answer, but it's largely dependent on your situation when you should convert. With one large caveat that I think generally everyone can take advantage of, and that's if there's some sort of stock market dip intra-year, right? And even in positive years, we saw that. So COVID was a great example, right? The stock market during 2020 was up something like 20%, right? However, by April of 2020, it was down 30+%. that's a great time to convert, even though it's scary, right? And I know that gives a lot of people some heartburn, right? But what you want is the recovery of those dollars to happen in a tax-free account, right? So there's always opportunity. And typically, the volatility in the market presents a great opportunity to do a Roth conversion. And for the investors that have been with us a while, right, you know that we are very focused on increasing the number of shares in our portfolio, right? Because the number of shares dictate our dividends, right? They pay out the dividends based on a number of shares, not the value of those shares. Well, this is once again an opportunity and an advantage we have in Roth conversions. The IRS taxes the value of the share, not the number that we convert, right? So if we convert a share at $100, they're going to tax that conversion at $100 a share, right? However, if the stock market goes down 20% because it's, a bear market, so to speak, that same share is now worth $80 as opposed to 100. So if we convert that share at $80 when it's down 20%, we pay a lesser tax bill on the same conversion of numbers of shares. And I know that gets a little nerdy and in the weeds, but that's a huge advantage, particularly when we're talking about generating cash flow from our portfolio. We want to get those shares converted when they're on sale so that they recover tax free, and then from there on continue to spit out tax free cash flow via dividends or internal capital gains. So I think those would be the two things. Maybe one or two other comments on that. If you're a business owner and your income can really fluctuate from year to year, that would maybe potentially determine or impact the timing of Roth conversions. Or if you're a W-2 employee or salary employee and you typically get like a year-end bonus, we might want to wait closer to year-end because that could fluctuate and potentially impact how much we want to convert, right? So other than that, I would say, organic dips in the market and, just really having a good grasp on what your income is gonna be. Those things are going to be pretty big levers in terms of when and how much we're going to convert, if that makes sense for your situation. So, John, hopefully
Okay.
that answers the question. Hopefully that was helpful to everyone else.
Love
Yeah,
it.
that
All right,
is
let's move on.
thanks, Colin.
You got it.
All right, let's move on to the second topic here, which is if we think about how the money transitions over to your beneficiaries. I think we have found a pretty big gap here as well, just in general society. So let's pretend that you have husband and wife, and then God forbid something happens to them, and they have, let's say, 3 kids, right? They've got Cindy, Billy, and Rick. And Cindy and Billy and Rick are all married. What I want all of you thinking about is, okay, God forbid something happens, to you and your spouse, and the money goes to those 3 children, right? First of all, do you want stipulations put around that? Is it given to them in a graduated way, an otherwise contingent way, or is it a windfall event? And are all of them responsible enough to handle that inflow? The second thing is, if they are all married, what happens if one of them gets divorced? Right? Have you thought about, hey, when that money lands in the pocketbook of my daughter, and God forbid her husband goes out and cheats on her, and then they now get divorced, how much of that money, walk us through, how much of that money do you want exposed to the risk of now going off to the no longer related to you ex-spouse? And there's no right or wrong answer to this, but as you could imagine, this can create some nightmares. And what I would say is really think through your estate planning documents. And if you need our help, call us and we can, help talk you through some of it and bring in an estate planning attorney to examine it. We might really want to think about that because it takes decades to build up your wealth. It takes a handful of months to destroy it. Divorce, disease, indecision, et cetera, et cetera. So you want to think through these things, right? How can we take the inverse of the problems and say, okay, what catastrophic events can we avoid? Right? If we're taking out a full spectrum of looking at all of our legacy planning, et cetera. Colin, passing you the mic, buddy.
Yeah, two big patterns I've noticed when it comes to estate planning documents. First off, they typically what we've noticed is there are beneficiaries that have been outdated, right? Or the legal document hasn't been updated in some time. So, for instance, you got a trust, or you went to an attorney, you drafted up all of the necessary documents, but that was back in 2004, and it's been 20 years since that's been updated, right? Second thing, and it's a crazy high percentage of instances where this takes place. People will go to an attorney, have a trust drawn up, and then they won't fund the trust. And that's just legal talk for they won't make the beneficiary of their assets or contingent beneficiary of their assets the trust. So ultimately, that two, three, $4,000, expensive piece of paper that you purchased and worked on with the attorney ultimately turns into just a glorified paperweight. Right? And I don't quote me on this, but it's somewhere in like the mid 80% of trusts never get quote unquote funded, which again means that they are not titling their assets to ultimately process through the trust. So again, reviewing your beneficiaries and reviewing your legal documents on some sort of frequency, maybe once every 4 or 5 years is probably a good rule of thumb, right? Those things, as tedious and as boring as it might be, you wanna keep up on those things, or else those again, where you think it ends up versus where it ultimately ends up is, probably outside of your wishes. So those are 2 big patterns that I've noticed in, just the last handful of years or so, as this is becoming a growing concern for the baby boomer generation.
Yeah, and I'll add to this. So I think there's two sides of how to solve this problem. Number one is actually going through the formal documentation part, but then the other part is actually having the conversation with all of the key family members or stakeholders. You'd be shocked about how much ground you can really make up for with having just a single conversation every year. If you ever need us to help facilitate that, we do that quite frequently, and where we just sit everybody out down at the table and saying, "Hey, let's run this fire drill. God forbid something happens to mom and dad. Hey, Ricky, you were put in charge of everything. Tell us how that would go. Mom and dad cannot talk right now. How would you run this?" And 9 times out of 10, when we run these fire drills, there are enormous gaps. But I'd rather us find those gaps right now than when the actual real thing happens. So better to be done in dress rehearsal rather than the real thing. Let's introduce one final topic here, and that this is a topic that honestly really concerns me. And I think it's one of those things that for many families, it's not a problem to be solved; it's a risk to be mitigated and managed. So that's the problem of long-term care. So if you look at it from a mathematical perspective, um, I'll draw this graph on here. So traditional financial planning, right, is saying, okay, I've got my expenses, and that my expenses are going to increase over time at a certain rate, right? And as long as my income, right, is larger than that, then this distance between this and this, as long as we have a healthy distance there, we've got some cushion, et cetera, then we're good to go. We can do that through our entire life. But there's a problem. Well, one of the problems that I call it's bubble risk, and bubble risk meaning that there are these potentially catastrophic risks that when they hit, they're not to be projected on a linear basis. That it's when they hit, they tend to have this very expansive type of problem, right? So imagine this bubble, and this being defined today as long-term care risk. Now, I wish I had some good answers for this, but the reality is these expenses can be quite enormous. In fact, we have a client right now who is paying for his father. And here's the other thing: it's not just your risk or you and your spouse's risk. It's also the risk that your parents, if they're still alive, cannot pay for their own long-term care risk. So, I mean, and we've seen numbers, especially out here in California, 15, 20, $30,000, right, of expenses per month due to a long-term care event. And my understanding is it's right now, I believe for like a person who's 65 years of age, it's a 70% chance that that person experiences a long-term care risk at some point in their life. So now you have to take that 70% chance for you, 70% chance for your spouse, 70% chance for each of the individuals of your parents if they're still alive. And you might have 4 parents between you and your spouse. So this represents an enormous risk. like an absolutely catastrophic risk. Um, I can't stress this enough. Now, there's several ways of solving it, and sometimes, honestly, you can't solve it all, right? Because anytime with risk, it's okay. We might not be able to do anything about it. That's number one. Number two is you could outsource it to an insurance company, right? That costs a certain amount of money, or you could self-insure, right? Those are the three main umbrellas of which you can manage or mitigate risk. But I want to be honest with people. This one is the biggest one that concerns me. Right now, we have clients. Unfortunately, uh, husband has a neurodegenerative disease, to an incapacitating degree, and then unfortunately, the wife also has terminal cancer. Right, so you could only imagine, right? Number one, how devastating that is emotionally to the family. But then number two, how devastating from a financial perspective that could be to a family. Because now the burden is now of paying for everything is on their portfolio slash their children. Right. And that's besides all the administration and everything handling it. Colin, what comes up for you, buddy?
Yeah, well, I think to your point, this issue, this problem ends up on someone's plate, right? So, and I could tell
Yep.
you, literally a handful of personal stories in my own family. My mom has been the caretaker at the end of life for both of Joel's grandparents, both of her parents, and my great aunt, her aunt, right? And this is all within the last, let's call it 7 to 10 years, right? 5 family members that and the largest issue is only really 2 of them were actually in a facility. The other 3, because of money, right, just ended up on a family member's plate, right? So, and even with the 2 being in some sort of assisted living, long-term care facility, my mom still had a heavy burden to bear, right? So, that's with help. So, one of the things I frequently hear from our clients is, "I don't want to be a burden on my children's life." Well, I can promise you, if you bury your head in the sand and don't build some sort of plan around long-term care, you will end up somebody's burden, whether it be your children's or the government's. And I promise you, Google a Medicaid facility. You do not want to be the government's burden, right? So you want to do the planning on this right now, before it gets basically too expensive to even consider hedging against that risk, right? The older you get, the insurance company's just gonna look at you like a more expensive problem, unfortunately, right? Like, this is one of those black swan events that we are probably doubling down on at this point of saying, "Hey, you wanna talk about true financial risk to your lives? This is one of them, right? A long-term, extended, long-term care facility stay will, not only potentially disinherit your children, but let you run your situation into the ground. So we should definitely have that conversation at an upcoming meeting or a review meeting or whatever it is, if there is no current plan for long-term care, 15, 20, 25 years down the road.
Right. Exactly. And to wrap all this stuff up again, we really want to think through not just money management. We are talking about wealth management, right? Which is, yes, one part of it is how you invest your money. The other part is, what about taxes? The other part is, how do we transition things through estate planning? So we want to think through all of these methods. And what comes to mind is the phrase of, you know, wealth management and how you manage your capital is about allocating finite resources towards infinite opportunities, goals, and obstacles, right? We don't have $1 billion of capital, right, at the family level to be able to say, okay, we're going to hedge all of these things. We want all of these things done. No, we have to be selective in what we want to manage. So if anybody has any questions about any of this stuff, I know we just threw a lot at you. It's kind of like drinking from a fire hose, but I just want to plant some of these seeds. So if it happens to resonate with you or your family, or you say, hey, I do have these gaps, or hey, I have not reconciled my beneficiaries to my trust, et cetera, like, call us and we want to serve you in that way. We want to be able to solve these problems so they don't become disasters for you guys in the future. Colin, final words of wisdom, buddy.
No, this is great. I do wanna answer the one client question that we had coming in about the stock market in regards to the upcoming election. So I'll leave
Mhm.
you with this. I would tell you the same thing last year, the year before, the 2020 election, the 2016 election, the 2028 election, etc. We are invested in businesses, and I don't care who gets elected in November. Coca-Cola and Costco and Home Depot and Apple Computer and Microsoft are going to wake up on November 6th and November 7th and November 10th and next year, etc. And they're going to want to do better business than they're doing today. Right. So do not, please do not let the Fox News and CNN and those outlets deter you from making correct, solid, strong financial decisions on a personal level for you and your family. So if you aren't catching the drift, I do not think you should be pulling all of your money out of the stock market simply because there's an election in 25 days or whatever it is at this point.
Yep. Yeah, excellent. All right, guys. Always a pleasure. Love you all. If you have any questions for us, give us a call and we can go from there. But if we don't talk to you, everybody have an outstanding rest of the week and weekend. Thanks, guys. Bye.
All right. Thank you, everyone.
Bye, guys.
Thanks.